Welcome to the Weekly Notebook Review. I am Robert McGroarty. This podcast takes on a bit of a different format where we are live each week on Twitter Spaces. I crack open my notebook and review Hedgeye research with anyone who wants to learn a better way to invest. We feature both Hedgeye power users as well as some special guests that might pop in. If you want to learn more about our research, visit hedgeye.com. If you'd like to participate in the live stream, follow me on Twitter at HedgeyeRJM. Now, let's review the data.
Good evening. This is the Weekly Notebook Review, and I'm your host, Robert McGroarty. I guess the one, the only, eh? Anyway, it's August 9th. I never opened the Weekly Notebook Review with that, so forgive me. But it is August 9th. It is about 8:30 on the East Coast here. I hope everyone's having a great day and a great evening. We are on the eve of what everyone is talking about, CPI and then PPI. The big data points that nobody used to care about, but everybody anchors on them now. So it is, the goal tonight is to kind of remind everybody that these data points are just that, right? So they are numbers that will eventually go into the nowcast as actuals versus the estimates, and then we just kind of read and react from what the market is doing and what we're seeing out on the board, right? How the nowcast updates, how that may impact or change any of our quad outlook, and then but really it's about anchoring on the signals, and that's what tonight is all about. It's about reviewing signals, and that's how the Weekly Notebook Review started back in November of 2021. Just a bunch of Hedgeye subscribers, and kind of going through their notebook, reviewing the weekend work, what was transpiring midweek, any updates, kind of changes that were shifting, and then how are we going to kind of get better and kind of pivot the portfolio for the end of this week, next month, next quarter, et cetera, et cetera. We are about 10 days into the first month of third quarter. And the nowcast model has not changed. So just for a reminder for everybody, we've got, currently conditional probabilities of back-to-back quad fours and then back-to-back quad threes to start the 2024 year. Now, the Q4, Q1, Q2 are all kind of basically pretty, the nowcast basically oscillates, kind of, I'd call it a give or take a 35% conditional probability of the quad 4, quad 3. And so, we're, as data kind of rolls in, those numbers may shift and the conditional probability may favor one quad versus the other. But at the end of the day, it's, these signals really guide us in both the risk range, the trade trend levels, and as Keith has been talking about most recently with David Salem, who's going to be hosting the macro show tomorrow morning, and his capital allocation product, which is focused more on kind of like that 9-month plus time horizon, and therefore kind of the more of the trend tail duration. But with that, why don't we kind of jump into it in regards to the sort of something that I've been doing the last couple of weeks, which has been more of the top 3 things. And the last 2 weeks, they haven't shifted. This week, kind of similar. And I think that's probably, for paying attention, which I know many of you are, and I appreciate everybody tuning in and listening, participating. It's been obviously wonderful and humbling to see how we've all grown together. But with that, it's the last 2 weeks it's been about volatility. So the VIX, give or take, and rates, and then the dollar. The dollar still is a key piece, but for this week, I'm going to kind of focus back on volatility, rates, and then more foreign currency versus just the dollar. So we're going to kind of broaden it out a little bit, but volatility in regards to the VIX in particular, we kind of had basically a flat day. It was kind of all over the place, and even the S&P was sort of end up closing down only about 70 basis points, but certainly was a wild ride today from a volatility standpoint. I think we touched a high today of I think it was close to well, yesterday's high was around 18. Today's high was almost 17, 16.87. But with that, anyway, but volatility and what we've been kind of talking about the last week or so is when we get this vol spike, like what happens, right? And does it sort of fade back down pretty quickly like we've seen in the past, or do we kind of get a reset? And then what we've seen in the last sort of week or so is that we have had a reset to the kind of more the top end of the investable bucket versus more of that kind of, low teens, which we've been used to since kind of, early June to the end of July there. So again, like that's really what I'm kind of that and obviously volume has picked up on this down move here in U.S. equities, which has been interesting. So both volatility has picked up and hasn't really subsided. Now again, today was a slightly down day on the VIX, but I'd call that more flat considering it was down 3 basis points versus yesterday. And still elevated. The low end of the risk range keeps coming higher. So today's low end of the risk range on the VIX was 14.29, and that top end keeps kind of pushing higher as well. So we had 17.93 as of this morning. So again, that's telling you that really from a daily range standpoint, the probability is that we're going to stick around, call it, to round it off 15 to 18, which, as I mentioned, is the top end of the investable bucket. So, pay real close attention to what's transpiring there from the risk ranges and whether if that range is shrinking, then that means the vol is sort of coming out of volatility, and therefore, maybe we get to a bit more of a new level, but sort of a still an investable level of kind of that 16 range. I think time will tell, and as we go out in space, we're going to learn a lot more, and yeah. So with that, I think in this case, we've gotten, and just to kind of again, I see David's listening in, so we've gotten a few comments recently about kind of sharing the trade and trend levels, and that trade and trend level on SPY is so the trade is 455 and the trend is 462. Again, that's as of kind of Keith giving it to David and myself and a couple others over the weekend. So just want to kind of share that with everybody. So trade and trend are both bearish, right? And are significantly, even trade is up at, so that's on SPY, right? So, trade's up at 455, which is where we were kind of, before this sort of, this initial dip, basically the end of July, beginning of August, we were kind of north of that trade level. And now we are well below it. And so that momentum is certainly to the downside. And again, as I said, it's been on volume. Even today on the SPYs, you're at basically 100%, a little over that, 101% of your 5-day average volume. So we end up closing down, and that's something that you don't want to see, right? So if you're kind of a bull out there, seeing SPYs down on volume with volatility kind of relatively flat, call it, but your vol, your VVIX up slightly, and certainly that VIX 9-day, pushing higher as well. The shorter end of the curve, those are all, that's a setup that's not really very good. So what you're really going to want to see, if you're a bull, you're going to want to see that volatility start to creep back down towards that 15, 14 level, and you're going to want to see volume pick up on up days rather than be kind of down on up days. So if you go back to 2 days ago on Monday, when we had kind of that up day of on the SPYs, you actually had down volume. So volume was only about 77%. Again, I'm using a 5-day average volume at time. So that's basically what you don't want to see, considering you had 2 really big volume days on the prior 2 down days, aka on August 2nd and August 4th. And a continuation of such today as well. So that's kind of volatility. You're seeing that complex really ripples through both VIX and RVX. So basically NASDAQ volatility as well as Russell Vol. Russell Vol is kind of hanging in there, just around 21, whereas VIX's more. It was up 2% today, up to 21.5. So NASDAQ actually looks way worse than SPY, but we are short SPY on the board. And not NASDAQ yet, because NASDAQ is actually bullish trend at the moment. I've got to go down the complex there from a volatility standpoint. So just to kind of round out this thought on vol, the move is still on basically very elevated, certainly at lower-ish levels of what we've seen in the last year, down at kind of sub 120 at 112.5 is where it closed. So keep an eye on that. I mean, the rates and certainly the longer end of the curve, the 30 and 10 year, And we had been sort of invested in that belly of the curve. They kind of call it 7 to 10 year in IEF, and then a little bit of TLT and even BNDD, which we actually took off the page earlier this week on Monday. And that's just kind of the rate complex and just kind of this, I'll sort of come back to this, but might as well just finish the thought here on move and wrapping it up with rates. But basically, rates just keep making higher lows and really, higher highs, but more importantly, the higher lows. So what that means is that, from a flip standpoint, or, on the longer end of the curve, that's telling you that the Fed is likely, in the bond market, is pricing in the Fed is raising rates and raising rates and staying higher for longer. So, whether, typically, what we had been seeing, and one of the reasons why we were kind of long of the belly to the longer end of the curve was because of the recession risk on the horizon. But although that is still in effect, it's not, the rates environment and yields in particular basically keep going higher. And that TLT trade was a really great one, and certainly BNDD as well to get out of this week. And once again, that move at 112, if you look back historically, even on a 5-year look back, so if you just pull it up on a chart, the move, I mean, typically, prior to kind of 20, the middle of 20, kind of Q3 of 21, your move basically was between, call it 75 and sort of 40, right? So, that's kind of more of its typical range of where it trades. Whereas for the last 18 months, we've basically seen it north of 100 and all the way up to sort of that 180. I think that one day it got almost all the way up to 200. So just keep that in mind as you're kind of looking at the fixed income and rates environment. EMB has actually kind of probably stands out to me as an exposure that from a fixed income standpoint looks pretty good. That's US dollar emerging markets bonds. We are long of EM ex-China, so kind of does play off of that. And then obviously the dollar as well, although we're not officially long UUP, the dollar is bullish trend. And this was kind of, would be a way of sort of having a hedge on that dollar position or any dollar weakness that might come down the road and that kind of thing. So I just wanted to call out EMB. So that's Echo. Oh man, Weeks is going to kill me. He was just busting my balls earlier today about not knowing my alphabet. I know it's Echo. What's M? M is, I'm just going to go with Mary and then Bravo. I know I got the E and the B, but Weeks, you got to help me out with that M. What is M? Doesn't matter. Anyway, so the move is doing its thing. Rates are certainly doing theirs. The 10-year, it's just this move in the last kind of week has been kind of, to call it crazy, is not really the right term, but just to think since July 20th, we've gone from the 19th, which we've gone from a closing low of 3 spots. M is for Mike. Thanks, Mike. Thanks, bud. It's a 3 spot 752 to closing today of just north of 4. But we were up at 4, almost 420, 4 spot 184 yesterday, a couple of days ago. So it's been a massive move in the 10-year rates environment, and let alone the 30, which again, even in the last week, since last Tuesday, August 1st, from the beginning of the month, we've gone from basically 4 handle, call it, to 418. So almost a 20, basically a 20-point move in the basic point move in the 30 year. So big moves there, and one to really just kind of let it sort of breathe and let it happen. You can try to catch a falling knife if you want, or kind of try to catch a bottom in TLT, but I think you're going to have a lot of opportunity to do so, and certainly at better prices. Better prices. What I mean by that is more of where the trend is more confirmed. So even though you may be paying up and buying at 101 or 105, you're going to have a much better kind of signal and a trend signal from there, which is so when getting long it'll be a better entry, and that's, I think, something that Keith sort of mentioned on the macro show today, that we don't necessarily need to catch the bottom or need to find the pivot or be right there when things do pivot, because we'd much rather have a better signal strength and get and enter a piece of inventory when the signal remains strong, where it remains bullish trade and trend, and hopefully kind of basically getting exposure to it with that with a really strong long trending cycle. So with that, let's move on. So just one other kind of volatility components wanted to touch base on both OVX and GBZ. I know gold and silver have been sort of I've had a lot of questions on the macro show the last few days. GBZ is still down at 12.33. So again, this is that vol environment is fantastic, right? So the gold itself it closed down at kind of call it 1948. The low end of the risk range today in gold was 19.19, and the top end is around 2010. So I still got a little bit more downside there on the in regards to the low end of the risk range. And I think this is a big component here. A lot of people are kind of wondering, okay, what do we do with gold here? Is it a good time to buy? I saw a tweet from a good friend of the program out there saying how Keith is, Coach Keith is buying some gold. And he didn't share that in the re-rank today from the Macro Pro product in regards to being a buyer of gold. So not sure if, I think maybe he was just being a little bit more patient in regards to letting it get to the bottom of the risk range there. GLD did actually break trade. So this is another one that I'll share. This is probably going to be the last one, to be honest, that I'll share from a trade and trend standpoint. GLD's trade is 180 and the trend is 175. So again, this is where, having that, him seeing that it kind of broke trade recently, he probably just kind of is maybe waiting to watch it a little bit more to kind of really gross up. We're still long gold and precious metals, but certainly I think being patient here, and that's been a good decision by Keith and the team. And I'd recommend we kind of do the same thing. He was actually grossing out more of his Japanese exposure and some EM as well as so just kind of using that rather than kind of beefing up the precious metals. He was actually kind of pivoting and putting capital to work in Japan and some of the EEM ex China. In fact, we actually got out of GDX altogether earlier this week as well. So just wanted to kind of highlight that. And with oil, that thing's just been an absolute rocket ship. So this, even if the CPI print tomorrow isn't elevated, I can't imagine that where you've had basically the whole month of July here, oil itself, which is the second biggest component in the inflation calculation. It's gone from a low to start the month of July down around 70 to closing high on the 31st of 81.80, and we're closing the day around just north of 84. So it's certainly been a big time different complex. Now, again, if you kind of zoom back a little bit from last year, we're sort of right at just above kind of where we peaked out in mid-April, and just below kind of that really big sort of the start of this move lower back from early to mid November there. Was kind of right around the same 84, 85 level. So just keep that in mind. Again, not that it's overbought. I mean, again, if you oil has been a great exposure to have on in the last, as I said, in the last month plus. But in this energy complex again, but this is kind of at the top end of the risk range. And so we wouldn't be chasing oil itself up here, but certainly, this is a great example of a trending asset that really has picked up steam and has maintained it. And that's kind of what you want to see. Continue to put in higher highs and higher lows. That top of the risk range is probably going to move higher again. Tomorrow's 83.89 coming into the day. So we're really going to, so you're going to see that kind of move higher, and the low end of the risk range move higher as well. And that's kind of what you want to see, and you're seeing it on volume, especially last two couple days. You're seeing big volume days on the up moves, and any down move, it's on light volume. So again, that's kind of exactly what you want to see. And although that OVX did accelerate today in terms of moving higher, moved up about almost a little over about 5.25%. It's actually sometimes that is a good thing, seeing vol accelerate on positive price movement and on big volume as well. So don't really let that kind of move scare you. It kind of keep you away, especially given the fact that it is sub 30, and that is absolutely the investable bucket. Continues to be around 28, about 30. That's right in the wheelhouse of the investment bucket for OVX as well. So just kind of wanted to touch base on those three things. I think from an FX standpoint, bullish trade on, as I said, on the dollar. Bullish trade on the dollar, bearish trend on the euro. We got bullish USD yen, neutral, which is kind of a recent move on the British pound, and Canadian dollar versus USD is back to is bearish trend at the moment. So I think an interesting comment today from Wasim. So big shout out to him. He was a Hedgeye Live invite. Well done, my boy. But he was asking about Canada and the outlook there. So Canada remains in kind of a Quad 4 environment, but they obviously do get a lot of boost, especially from the economy and growth standpoint, from natural resources, certainly energy in and of itself. So with some oscillating kind of Quad 3, Quad 4 action, I think kind of commodities exposure in general is going to be a place that you could see really could benefit from a number of quarters. So you could see kind of David texted me, he's driving, he can't talk, but that lines up really well in terms of kind of that longer term outlook, and that's something that a lot of folks I won't say struggle with, but certainly a desire is to kind of don't necessarily want to set and forget it, but I'd like to have kind of pieces of inventory in the portfolio that I can kind of have for a while and maybe not rotate as much, et cetera, et cetera. And so, given this the nowcast out there, now there's going to be good days and bad days, in terms of when you want to add it and whatnot, but energy and sort of natural resources, and we certainly have added exposures like uranium, nuclear, right? So XLE, what else we had recently? Anyway, it doesn't matter, but basically, yeah, just energy complex as a whole. That's going to be a place where I have a pretty good feeling that we're going to be kind of, especially as long as the signal kind of holds up here. Obviously, that's the biggest thing. But if that holds up, then we're going to be kind of most likely have some components of energy and commodity exposure in the portfolio for the next 3 to 4 quarters, which is a big shift from where we came from for most of 2022. So the fun part about this game is that the game changes and the signals shift and the outlooks change and the flows pivot and shift, and it's really fun to try to navigate that. But with that, we got somebody who's coming in to talk or request. We can open it up if folks want to jump up and review anything. Happy to do that.
Robert McGroarty here, Director of Subscriber Development at Hedgeye. Join our entire research analyst team live before the market opens for deep dive investing analysis, our favorite stock ideas, and our risk manager-in-chief, Keith McCullough's macro overlay. Our team of 40-plus equity analysts discuss key market developments, trends, and our high-conviction long and short investing ideas. You will not get this granular level of insight anywhere else. A video replay, audio version, and analyst summary notes from the call are available shortly after each live show to ensure you don't miss anything. Go to hedgeye.com/research to subscribe. And tune in live to the call weekdays at 7:45 a.m. Eastern. Enjoy the rest of this episode.
The other components, I guess, if we want to run through a bit of U.S. equities, I think XLK, obviously the breakdown here in regards to both the big components of that, which would be Microsoft and Apple, both have shifted to bearish trend, and XLK as well just continues to break down. Which obviously makes a lot of sense given what's been transpiring with Microsoft and Apple. But I think that's a big pivot and big shift from what we basically have seen the year to date, call it. And so that breakdown in momentum to the downside is something that we definitely want to be calling out, because that's from 2 weeks ago. That's obviously a big shift versus the fact that had been bullish. XLK. Moved to neutral, right? So it had been, bullish, bullish trend. Now the ETF itself is neutral, but those two biggest components are bearish trend. So I wanted to call that out. And then obviously another big one that folks care about would be the XLY with Amazon going to bullish, but Tesla, another big component of that, bearish. So consumer discretionary is certainly, I think, an interesting one in terms of, does Amazon sort of, bully that one higher a little bit? Or what happens? For me, it's kind of turning into a bit more of a just don't play in that zone at the moment. I think the XLK signal to the downside certainly looks a lot better. And I like kind of seeing that neutral, that shift to neutral from a trend standpoint with the anticipation and perhaps the ongoing kind of move lower. So this, if you're looking kind of the downside, that could be a good place to hunt. XLE was added to the risk ranges. That is bullish trend. And again, so we've got bullish trends of both healthcare, energy, defense. There's a lot of places that we like to have exposure to. Healthcare is certainly one that we've been adding to recently as well. And it's had a good, after kind of having a bit of a head fake there. Was that last week or earlier? Last week it was. Kind of rebounded, although, again, give you a bit of a good spot to perhaps add some more today. We're fans of both Pink and healthcare itself. So just wanted to kind of touch base on a couple of those things. Bitcoin is another one that Keith mentioned is kind of on the cusp of maybe going long. Bitcoin does like Quad 3. It is a commodity, so that does make sense. But for me personally, I'm going to get that one kind of to give it a little bit more breathing room, right? So I don't need again, not that Keith's trying to front run anything, but I think I've got some commodity and primarily energy exposure, so going to kind of ride that wave out for a bit. But kind of would be an interesting move to see Bitcoin move higher. So just keep that one in mind there. And does anybody have any questions? I mean, I've been talking for 25 minutes, but I certainly can keep going. I see George out there in the crowd, X2. You love to trade the euro. What else have we talked about here? So why don't we go back to, I think the biggest thing is, here we go. All right. Because this is really for you guys, right? So it's all, welcome. I'm going to say, we'll call you Jesus Christ, I guess. I don't know.
Oh, yeah, definitely not Jesus, man. Just a follower. Just a follower, for sure.
Follower. I love it.
Yeah, man.
How you doing, bud?
I'm doing all right. By yourself?
Good.
So, just wanted to hop on here. I know you were mentioning Bitcoin, so I wanted to throw it out there. AULT, they mine Bitcoin. Kind of the CEO is kind of a scam a little bit, but they're going to dilute it heavily at the all-time lows. So I don't know if you guys are like to short stocks or short penny stocks, but I mean, nearly every day now it's down like 5% or so. So just throwing that out there.
Yeah, perfect. Appreciate it. That thing is going from a hundo to $2, $2.25 in the last year. That's actually a crazy chart. That was not on my radar, but things like, again, if you're kind of looking at that environment, block is not something that we're along at all, but different ways of playing, kind of, if Bitcoin does move, right, there's a lot of different ways of playing it. You don't necessarily have to buy Bitcoin itself. You can buy things like WGMI, which would be your Bitcoin miners. That had a nice run there going into kind of the, kind of looks a lot like the Bitcoin chart, to be honest, running up right into kind of middle of July and then kind of failing here, but still maintaining a good little uptrend there. So that's one that I was kind of looking at today, WGMI. And then you've also got things like, I think it's just Crypto. No, what's that one? Crypto. Basically got Maestro in it. There's another ETF. I'm drawing a blank what it is, but the miners is certainly one that I'd be taking a look at, taking a stab. PFIX has been acting really, really well as well. Just to call that one out, I think we did call that out a couple weeks ago. So that's the interest rate hedge out of Simplify. It certainly acts really well when with the bond vol and certainly interest rates moving higher. So I'm going to call that one back out as well. Some of the other components on this screen, I mean, India continues to look awesome. So that's certainly, if you don't have that in your portfolio, I'd be highly recommending to do so here. It's been, basically, it's had a nice little pullback the last couple of days, last week or so. So yes, that's definitely one that's high on the list. EWJ Japan, obviously, I know we keep talking about it, but it's sort of right there at a great spot to potentially add some more if you depending on what your sizing looks like. Again, just as a reiteration, we go mid, max, and for an ETF like Japan, really that max sizing would be no bigger than 6%. But we do have 4 different potential exposures that you could have, including small cap Japan value, and then JPXN, which is really the indices itself, I believe it is. So so those are kind of the 4 things that we'd be looking at from the long side in Japan. South Korea, we kind of we haven't booted it yet, but it certainly kind of has moved down the list. I know we talked about that last week in terms of areas of EM that we liked in terms of South Korea, Japan, India, Vietnam, even the Philippines, but both Philippines and South Korea have moved certainly down the list, but Japan and India kind of remain up there as great areas for some exposure. So you can get India exposure via INDA or also INDY. INDY is the top 50, India 50. So that's actually been a great one to have in the old portfolio. It's been working really well for the last well, that chart has been awesome since basically May. We got long India within the last month or so, but so yeah. Any other question? Or I know you said all Bitcoin. Do you trade a lot of crypto or anything like that? All right. Go.
So if you're talking to me, I don't trade crypto, specifically because of like all the crypto scams and stuff. I tend to just stick to SPY.
Love it. Do you use the Red Eye Green Eye app from Hedgeye? Free one on SPY?
I don't. Red Eye Green Eye. I don't know what that is.
Never heard of it. Hedgeye has an app called Red Eye Green Eye. So if you just go into the Apple or Android store, just search for Hedgeye. It's a free app. Basically, we kind of toggle it between buy, sell, or snooze. It's currently in the snooze mode at the moment, but really, it's a great indicator in terms of kind of what we're thinking in regards to kind of getting longer or shorter of the SPY. So it's we launched that a couple months ago now, but it's free. Anybody can download it. So would highly recommend.
Sounds good. I'll check it out.
Yeah, appreciate it. Yeah, of course. All right, all right, guys. Well, listen, it's been a long day, so if nobody wants to come up and chit chat and ask questions or share any of their insight, then we can call this a wrap. A quick 35 minutes. I think that might be the shortest episode ever. But there's not a whole lot more I can say. I mean, there is, but it's a lot more fun with it. It's talking back and forth with folks. Yeah. I mean, I see so many friendly faces out there. John, Laura, Uniguy, Leslie, X2, George. I'm just going to call you all fuckers out. Corey. I mean, fuck, the list goes on and on, boys and girls. So somebody's got to come out here and, engage a little bit with me. But maybe you guys are all just, having your bourbon and you're having a little wine by the pool. I don't know. I know Leslie's in Colorado. So here we go. Roland's coming up. Roland, my man.
About Hedgeye Las Vegas that's coming up. If you got any
details. Yeah, bud. The early bird specials is wrapping up. I think it's the 15th of August. So definitely if you're interested in doing that, I'd highly recommend it. Roland's has attended, I think you've attended all of them, right? Yeah, you've attended every single conference we put on, which is incredible. So are you making it back out there or no?
It's a bit strange right now. I have to get more intelligent on my account.
All right, no worries. They're great times. So the Hedgeye regionals are different than Hedgeye Live, which is a 3-day event. The regionals are just 1 day. We are trying to kind of create some events around those, though. Just sort of again, you don't have to participate in them, but there's a golf outing on the Monday. So it's on September 12th is the Hedgeye regional in Las Vegas. There's going to be a golf outing and an opportunity to take a helicopter ride down to the Grand Canyon. which will be really cool. And then on the Wednesday following the conference, I'm hosting a live weekly notebook review, kind of in person for anybody who wishes to attend. That is free. The other two things you do need to pay for, but yeah, so it's a great time. Basically, the sector heads come out and share some updates from what they're seeing out in their general sectors, and then there are dinners, and I have the pleasure of hosting dinner with David Salem on that Tuesday night. So it's a great time, but a lot of those dinners are filling up. So if you want to have your kind of your I guess say or your first pick, we definitely highly recommend you kind of sign up ASAP, not only to get the early bird special, but also to make sure you get the dinner that you wish to attend and to have. So yeah, it's a fantastic time. George, how you doing, bud?
Doing well. Yourself?
I'm great, buddy. I'm great.
So
guess everybody's just has a great understanding of the process.
I think I know what's going on. I'll try to get a little conversation going here. I've got so much kind of neutral stances on everything, and things flirting with 1 month, trade momentum kind of shifts.
Yeah.
So I think everyone's kind of just waiting to see what happens tomorrow. And then, you kind of covered everything, and I'm kind of neutral going into long, waiting to see where things go. So I'm curious if anyone out there has, put their neck out on the line and has put a position on for tomorrow, one way or the other. I will say that the Cleveland Fedcast is hotter than the bank estimates, and the Cleveland Fedcast has been pretty accurate. So curious if anyone has anything to add to that.
Yeah, I mean, George, I've been more hedging the book with some puts in the last kind of 2 days. Really less about CPI and more just the signals I'm seeing on the board, right? So breakdown in that, as you mentioned, kind of that trade momentum, and therefore kind of an acceleration in volatility, and sort of as I mentioned earlier, kind of staying elevated or higher than what we've seen for the last few months. So that's been kind of the new thing that I've been doing in my portfolio personally, is not prior to, is definitely especially with volatility, especially with VIX down, even on spiky days, just to kind of 15 or so for kind of almost the entire month of July, or 14 and a half. Those are all kind of, to me, kind of buy the dip type situations, for lack of a better word, or lack of a better phrase, because I don't really love that phrase, but it is what it is. And whereas now it's not as clear cut. So yeah, George, I mean, I think it's you're spot on, and I'm not I haven't sold out of in terms of a bunch of my longs that have kind of broken down on a trade momentum standpoint, but I've certainly reduced some sizing, and I've started to hedge with a small amount of kind of puts, with anticipation. Again, if this momentum to the downside continues to pick up, then I'm going to be basically flipping it on a 180. And in terms of some of the things that I had been long, like QQQ.
Yeah, I certainly, just from the data, would expect a bounce tomorrow, because you have those large eyeball premiums indices. Not really there in the mega cap names, but they're closer to the low end of the range really than the top end. So in line or cool, I think you get a pop. Although I don't know if that's sustainable. In fact, I'd probably argue it might be short-lived, because just be more of the same with regards to the mini reflation, if you want to call it that. But at the same time, it comes in hot. We could just see a continuation. So I'm not sticking my neck out there one way or the other.
No, I mean,
and I have to come on and thank you.
Yeah.
As well, because you're the gentleman who introduced me to a certain simplified product. And I'm not going to give myself credit. I'll call it luck. I've traded that better than any other thing I've traded in my life. I somehow put that on July 19th and sold half of it Friday.
I love that. Good for you.
So very neutral going in tomorrow.
Yeah, and
Been a good.
listen, George. I mean, there's like different. I'm talking about my own kind of like personal capital, right? So like, there's a lot of different ways of managing money, and I know you do so in a more professional capacity for other people. And I think that setup, what you're talking about, being neutral, again, just like this shift that's happening. Again, we're kind of like, other than spies, but let's just say QQQs, right? Which is something that people have been wanting to be long, tech, et cetera, basically all year. But we're sitting in kind of much more of a neutral territory in regards to, as you mentioned, kind of a breakdown in just price, right? So although Nasdaq remains bullish trend, it's almost positive. Keith mentioned the other day that it's bearish trade. So that's a big component here, and the prudent thing to do is to get just kind of more neutral and to just sort of let the event happen and the event risk pass, and then and digest that data point and let it impact or influence the model in whichever capacity it needs to do, and then then just see what the signal and the price action, volume and volatility sort of looks like on the other side of it. So I think that's like a really wise way of putting it, buddy.
Yeah, if I want to recap kind of what I've been doing, because I transact a lot less than folks, even though every day I'm in the notebook and I'm writing everything down and paying attention. Most days I do nothing. But July 19th, I trimmed all the duration, gold exposures, put on that interest rate hedge, and went really heavy on the dollar, and didn't have to feed ducks until Friday. And then the only thing I've done this week is really adding some broad agricultural commodity exposure.
Nice.
Curious what anyone thinks of. If anyone has anything to add about agricultural commodities, I'd love to hear more about that. I know Keith was
doing like corn,
bearish on corn.
Yeah. Did you add like soybeans or wheat?
I did the biggest, broadest one.
Oh, like just
I'll try not to be specific with what I think.
DBA, basically.
It sounds like you guessed it correctly.
Not advice.
So, yeah, I did first buy yesterday, second one today.
Nice. Okay.
Because with oil, I don't really like to chase. It's not in my DNA. If we were going into like coming out of recession, I'd be much quicker to say, okay, bullish trend, full position on for everything, right?
Yeah.
But because of, I feel like we're standing on the edge of a cliff. I'm not as aggressive with adding a lot of the energy exposures. I'd rather them give me an opportunity, a little bit better opportunity to jump in.
Yeah, love that.
Hi, I'm Keith McCullough, and I wanted to introduce you to my favorite product at Hedgeye, the Macro Show. Why is it my favorite product? Well, it's my show. I do that every morning. If you want to get ready for the market day, you want to contextualize all the data, you want to make good decisions, then this is what you should be watching. It's a repeatable process that you can deliberately study, measuring and mapping time series to time series of data. So it's not going headline to headline and getting whipped around. It's actually being so much more dispassionate about it and making good decisions that are data driven. So we'd love to have you on our team. Come join us.
Tune in weekdays at 9 a.m. Eastern and on demand anytime. Go to hedgeye.com/research to subscribe.
Muni guy, welcome, buddy. How you doing, Brian?
Robert, how are you?
I'm doing well, man. Doing well.
Good. Normally at 8:30, I'm on the down low. I'm just listening and falling asleep. But I thought I'd jump on.
No, I appreciate it. Hey, it's all good. Yeah.
Share a couple of things that I'm saying with kind of where we are before CPI. Don't like to play the events too big, but I mean, it's actually a fairly meaningful number for the way I'm positioned. But a couple things I jotted down. One, just an update on my kid's 529 account, because I wrote a check today to the University of Kentucky for the fall semester. And it's a good reminder, and sat down with my kid and showed him the spreadsheet and the pro forma and
his little account, and sold out in January of 22 and went to cash. And if I would have stayed in the 3 American funds, I would be down 8.13% today, but I'm not. So, I've been posting a lot about the cycle to dates. I track them because I think people get lost sometimes, and we're kind of getting back into summer lows or, ending, and people are getting a little more focused, and booking gains and rotations and all these different things are happening. That's a good time to, I think, step back and appreciate that you have to take a longer term view. You just can't get caught up in the shorter term. But a few things that pop off to me, and then a couple questions for you, as I usually like to do. One is money. I looked at my money market rate this morning, 4.96. So, everyone should have a taxable account at Fidelity or TD or Schwab or wherever. Don't leave your money sitting at Chase Bank. If you can just pop it back and forth and earn a 4.96%, doesn't make any sense. I was pretty surprised when I saw the 496. I shouldn't be, but I was. And that's a pretty meaningful rate. Just remember, you do pay taxes on it. So, but it's a meaningful rate. So please make sure you monitor your money market rates to earn what's appropriate for whatever your situation is. Muni rates this week, I posted a few times that in the secondary market, there were a few bonds that I already own that I was looking to add positions to. They were 4s yielding 4.25, good credits plus insurance. And I bid the darn things at a 4.258, and I got DQ'd, and then within 48 hours, they're now at a 417. So we saw a rally on the muni side, and even though we're entering a little bit of higher supply, we're seeing good demand. So, that just tells me that people are buying munis, and for whatever reason they're buying munis, but we're not seeing a Q3-4 of 22 right now, where I have some older positions where I bought them at like a 490, where they're more distressed selling. Thirdly, actually traded EDV. I traded it. So I bought it at 4.25 when it hit 425. So I bought a nice chunk, and I think I sold it for like 2 and change percent gain within 4 to 8 hours. So it was a pure trade. It's not my forte, but thought I'd just throw that out there since you were talking TLT trades last time. But I am set up for long duration, to play the slow grind here into what I think is the ultimate goal, which is to have to bring interest rates down ultimately to keep this thing going one way or the other. On the equity front, I took a little bit of a stab in just very strong free cash flow companies. There's some ETFs that have a strategy where they just go through and do the screen for you. And I've actually had very good success with them. All 4 of them were up today. So I feel like a little bit of the rotations going on into companies that have pricing power, companies that have the ability to absorb, not borrow cash in a high rate environment. So that's been a little bit of a I'm going to say a little less than 90 days, about a 60-day strategy of mine. I put it on to have a hedge against my short positions. So I do have a couple short positions on broken companies. And so I just needed something to offset it. And it just seemed to fit the macro theme. And I've had some good success with that. And then Disney reported today. I always have to talk Disney when there's an event, and I will say I was pretty happy that they seem to have made some tough decisions. And then I think it's called the Tri-End Group, who has been very vocal against the board and getting back to their core mission and focus, didn't say anything negative today, which tells me that they must be in the background on board with the strategy. So I'm hoping that our family investment will continue to do well. But moving outside of sort of my setup, one, looking forward to listening to David Salem tomorrow on the Macro Show. Interested in what he has to say. And so I have two questions for you. My first one, you may not have the answer for, but Keith did us some comments on the Macro Show a little while ago talking about David, his new product, Macro Pro, and the possibility that there could be a product that is below Macro Pro. He called it a premium product of Macro Pro, but something a little bit underneath that. And I'm guessing that's a little more trend tail price point. Is there any information on that comment that he made? Or do you know what I'm talking about?
I do. I can't share it yet, though. He can, because he's the founder and CEO. So he can say whatever the fuck he wants. But we are in the throes of sort of coordinating and creating that product set. So just stay tuned.
Okay, I will. You know me, we had a private conversation that I'm very focused on trend and tail, and think it needs to be, something that a lot of people would benefit from. I'll just say it that way. Yeah, and it's more my speed.
Yeah, so David's product thing from capital allocation, that's an institutional for the moment. Institutional is where it's basically going live here in the next few weeks, and that's institutional out of the gate. That is, again, as I mentioned kind of earlier in the call, it's kind of call it 9 months to 9 months to kind of 3 years type thing. So much more on our trend and tail duration. He just actually flipped me over the deck that he's going to be using tomorrow on the Macro Show. It actually kind of he's using his Orient dashboard as he's deeming it or calling it, and so that's going to be kind of what you can. So it's awesome that he's going to be sharing that. So just stay tuned for the Macro Show deck tomorrow. Kind of get an idea as to kind of what you'll see from David in that capital allocation product. And then there's going to be kind of additional sort of additional kind of some other product sets that are going to be coming down the road. But just stay tuned there.
Pick the right day. I mean, CPI day. Everyone's gonna be on caffeine pies. It'd be it's a big day to be on the Macro Show. I like it.
Yeah. It's
so my last question is this little technical, but I think it's something that I haven't seen, and I'm just kind of curious. And since you said you had the ranges, it's just not necessarily for SPY, but just to kind of understand the ranges. Trade, trend, and tail. Like, what kind of distance between low and high do you see between trade, trend, and tail?
I'm not sure I'm following the question. Are you just talking about kind of like the separation?
Like if I said, hey, what are the ranges on SPY? And you would, say, want trade, trend, and tail. Like, what's the difference in how far of a, is there really a material difference between the three?
It 100% depends, because it depends on what price volume volatility looks like for that piece of inventory, right? So if you've had a big move, in price in a short period of time, then your trade will probably just naturally move higher, faster, because it's a shorter time duration, right? Because it's 15, basically 3 weeks or less. So it's going to start to incorporate the most recent higher prices, faster than a trend or tail duration, which, again, depending on where you're coming from. So let's just say, we'll just use tail, right? So tail is 3 years or less. So if you're going from, Disney could be actually a really good example, right? So, you have pricing even in the last year that's up at like 110, 112. I just have Disney up here. So, and I know you're intimate with it, but then, it's got a lot of pricing down, it's got a lot of pricing in the last year between, 103 and really like 85, right? So, it's tail. Yeah. So like trade, it might break trade, or it will break trade faster because it's probably a lot closer to, kind of existing levels. Again, I don't have trade on Disney. Okay. So I'm just making this up, but let's just say it's $90, right? Because it's basically, if you kind of just look at the look back window, and in terms of like where price is coming from in the last sort of 2 months time frame, let's just say it's around $90, right? So that's a lot easy, it's a lot easier to regain trade momentum here on Disney, because it's kind of like, call it, for lack of a better word, kind of bottomed out here. But trend could be significantly higher just given where the price action has been, and certainly tail would be, could be a lot higher given where the price has been for the last year to 3 years, let alone, kind of, the height of, I think it hit a peak of almost like 200 there, right? So from a tail duration, it's incorporating a lot of pricing that's almost, 100+% above where your current pricing is. So that's kind of how you got to look at it. It's less about where the gaps between the two. It's much more about where pricing is and what the volatility of that underlying piece of inventory has had. So because again, the VASP is price and volume and volatility. So that all basically plays a factor into what those levels, where those levels stand, and that's why they shift, right? They move as time and price, volume, and volatility, move out in space.
But am I safe to say, to finish this one, is it safe to say that trend and tail kind of, where you are within the risk range just moves a little slower?
You're trending. Because again, because certainly your tail, because it's incorporating, can incorporate basically, as I said, it's 3 years or less. So it really incorporates a lot longer of a look back period. So
right.
As you move out one day at a time, it doesn't necessarily shift, right, all that much higher or lower, because it's only kind of, again, from like a look back. If you think about it, like as you move out in time, you're losing some pricing from like the last day 3 years ago. Let's just use that as an example, right? So as we move out, well, if that was lower pricing or higher, maybe that was, so I'll just keep using Disney. If you pull up that chart on a 5-year basis, right? So, we're approaching 2020 or 2023. So we're December, so November. So basically right now from like a 3-year standpoint, you're losing the pricing from the pandemic, right? So that pricing that's basically down here between 90 and 120. A lot of that is falling out of the look back window on a 3-year basis, right? When you're incorporating, so you're incorporating, you still have all that pricing from basically 120 up to 200. And now you've got a lot new pricing here as well, down in the kind of sub 100 range over the last, 6 to 9 months. So that's kind of how you gotta, it's all about kind of like the look back window.
Okay.
Yeah. So that's where,
and trend we get on ETF Pro, and then trade we get on the risk ranges.
So those are different durations, right? So the ranges,
ETF Pro weekly.
The ranges are different than the levels, right? So the levels is where something like shifts from going bullish or bearish or neutral. Right. So if on the risk range product, if it's neutral, typically that means it's basically between trade and trend, or sort of like flirting with trend, right? So on the ranges themselves, that is the risk ranges are the trade duration, aka the immediate term. So using most recent pricing, aka like the last 3 weeks or less, right, for that piece of inventory. So that's like what is probable right now. What we get on ETF Pro and investing ideas, those are the trend risk ranges. So that incorporates a longer look back. So again, those don't fluctuate as much as price, volume, and volatility shifts. But if you get big spikes in price, volume, and volatility, those trend ranges will also move at so the tail ranges would be the ones that would be the kind of the biggest windows in terms of they'd be probably the widest windows as well, because you're gonna because you're incorporating like a lot more price or volume volatility. Exactly. So what I was referring to is more the levels themselves. Like those won't fluctuate as, especially tail level won't fluctuate as much. And Dave, in the capital allocation product, you're going to get those levels of trend and tail basically once a month. So you'll get those once a month, and again, like the reason for that is many, but for the most part,
It'll move a whole lot.
Yeah. Plus, like the outlook
materially.
Plus, the outlook is more, as I mentioned, kind of like that 9 months to kind of 3-year horizon. So, yeah, I mean, there's still big decision points, right? So if you're below trend or if trend breaks, then you're going to want to make a decision. And then if tail breaks, it's kind of, basically you want to be out of, again, it's just,
that's directional.
Side, right? So
directional.
More directional. Yeah, exactly.
Yeah. Okay. All right. Appreciate it.
Mr. Mute, so happy that you came up and talked about Disney.
Right.
Nothing I say is investment advice, but I have families just like yours that are Disney families.
Right.
So before earnings, I made sure all of them got an allocation on that Penn News.
Oh, good for you.
Yesterday. So we're currently with you. So what I wanted to say, though, is this. A lot of the call really reminded me of Netflix. Obviously, we saw what's happened with Netflix last year. But I just thought there was a lot of similarities, and I don't remember it perfectly because I haven't had time to go back and, go back through what happened with Netflix. Well, increasing prices, increasing prices, the whole ad platform, all that sort of stuff. Does anyone remember how Netflix reacted? Not like, I know what happened immediately into earnings, but thereafter, I think it drifted higher, but if I'm wrong, please correct me.
I don't recall, but on the theme of what you're saying about Disney, I do believe that they're at a turning point. I mean, they're backs against the wall. Tryon Group has said they lost their way. The Tryon Group's not out, with the baseball bat tonight, swinging it for people's heads. So my guess is that they've got the canoe rowing in a certain direction that at least the majority of the people are happy with. So more to come. Didn't think I would be talking about Disney and gambling 3 weeks ago, but good for them. Hey, everyone deserves to put a wager up every now and then. But yeah, and we're talking more fundamentals at this point. But yeah, Disney, we're all in. Let's just put it that way.
I will say this, though, when it comes to risk management, if it loses steam and breaks down, I'll be out as quick as I was in.
Yeah, our position is a lifer type position, but we're also Disney Vacation Club, all that kind of junk. So we are we're just one of those sort of like owning stock in your wife's company. You can't sell it. It's the same concept with this for me, but it's not going to be a life changer either way. But Robert, last thing for me, I said this last week, and I do want to say this again, because we're seeing some downward pressure success, and I think when that happens, kind of Hedgeye Nation anxiety meter goes down. It's a good time to reminder when people have open minds that risk adjust your portfolio. No matter what it is, it has a beta. And if you really want to move if you want your year to date to be with SPYs, then you're going to have a beta of 1, and you're going to have to make sure you correlate with SPY. But if you have a beta of a hedged book and your beta's 0.25, I mean, you're not going to move a SPY. So, risk adjust your return always, and just keep it real, and don't get all caught up in the narrative on SPY. I like the fact I'm not hearing about QQQ for 7 days. So,
it's a really good point, Brian, and one to be reiterated, right, is that you need to understand your time horizon, what you're investing for, what you're, and David and I have done a couple of videos on this, but in particular, make sure that you're treating whatever pool capital you're leveraging or sort of not leveraging, sort of investing in. Make sure that you're taking care of like the necessities first, and then figure out what's your return profile. And you raised a good point earlier too, Uniguy, which was that risk-free rate is basically around, just call it south of 5%, right? So for some, that's good enough.
It's medicine. I mean, it literally is medicine.
Yeah, exactly. So for some, that's good enough. And if that's you, then, do that and go have some fun doing other things with your family or friends or whatever. So really all just kind of depends.
Last comment, Robert, I swear to God.
Yeah.
So guess the beta of my portfolio.
So your beta is probably like 0.2.
0.1.
Yeah. You want to guess mine?
I'm gonna go with probably 180.
Yeah, that's pretty close. Yeah, that's pretty close. So
I was gonna say 2.25, but I'm like, man, it's a lot.
It takes a lot.
2.25.
It takes a lot to get 2.25. I've tried. Yeah.
All right. Well, I appreciate it, but I'm gonna try.
No worries. Yeah, totally, man. Thanks for jumping on. Shamrock Shakeout there. He was, as if I talked about gold, I did briefly touch base on gold. Now, where do we go from here is his question. So GLD has broken trade. It's holding trend. So again, like this move in rates has just been, got dollar up, rates up, and gold down. So, Keith touched on it on the macro show today, but I'll just reiterate it. I mean, gold likes real rates going down, and real rates have been going up. So it's I don't want to be like it's that simple, but it looked like it was going to kind of hold trade there for a bit. I guess that was probably last week on that pop higher, but it really kind of like failed right around the trade line. So now that trend, I gave that earlier, so I'll give it again. That trend level in GLD, where to go? Where did GLD? Oh, there it is. 175 is trend, and you get the risk range daily. I'm sure Shamrock with for gold the spot price, and GLD is remains an ETF Pro. So we remain long of precious metals. So that is certainly not changed. I think just understand what your current position sizing is, and if you're sweating this move, you're probably sized too big. So just that would be kind of again, I'm not trying to be flippant or anything like that. I'm just like sizing is a crucial piece here, as Brian Munigod just mentioned. Sizing and understanding the beta of your portfolio is crucial. But I mean, realistically, if you were a buyer, I mean, you beat down if you're a buyer last week, you're down like 3%, maybe. I don't even know. What was that? Maybe it basically went from 180 to 177. Not even quite that much. So let's do the math though. All right.
Hi, Robert McGroarty here, Director of Subscriber Development at Hedgeye. Hope you're enjoying our podcast. Start generating alpha with our suite of Sector Pro investing research products. Dive deep into retail, industrials, technology, and everything in between, with exclusive access to the sharpest analysts and actionable ideas on Wall Street. Go to hedgeye.com/research to subscribe. Enjoy the rest of this episode.
To basically 2%-ish. Yeah, 2%, call it. So rounded off. We're down like 2% last week. So, I mean, again, that's, I think, sizing, if you're sweating that, you're just too big in precious metals. The other component, the other question I had out there, so thank you for that, was from Nate. Thanks, Nate. That's about Japan. So he's asking, how's the long-term outlook on Japan impacting portfolio allocations? I have about 20% Japan. Nate, good job. I think 20%, again, sizing could be an issue here. I'm assuming you're 20% because you're like basically 5% across 4 of the ETFs that we are long and ETF Pro, which I mentioned earlier, which again isn't, you're not violating any individual size, but maybe 20% to Japan is a little too big for your for your general allocation. Not really sure. But with that, I mean, nothing's really changed on the outlook for Japan. It's quad environment lines up with, so the nowcast model, the quad environment lines up with the signal. Nothing's changed. So if, talk about, David said I was getting a lot of airtime here tonight, but he said, that's an allocation that we did an entire macro show on basically talking about Japan as a key case study I think that was last month or maybe it was a few weeks ago. So you can go check that out. EWJ though, again, Japan, I don't know, nothing's really changed. So I'll just leave it at that. So just stick with it, but maybe size them down on if kind of 20% is a little too much, maybe just size them down on a green day when that comes in the next, call it the next week or two, whatever it is, whenever that comes, just kind of size down a little bit, maybe take it down to 4% each and have kind of a 16% allocation to Japan. So, a big thing here that's, I'd say, just impacting generally international ETFs is this move in the dollar, right? So you've gone from basically, you've had almost a 4% move, not quite that much. Yeah, it's a little under a 3% move, kind of in the dollar to 2 and 3/4 basically, in the last kind of 13, 14 days. So it's been a big move on that front. It's been a big move on the rate side of things. So but nothing's changed on Japan front. Still long EEM ex China. Jay, I see popped up as Muni guy was chatting. I don't know if you had a question on the Muni front or a question for myself or the panel. Happy to take it though.
Hey, Robert.
Hey.
Quick question. Now it's not a process question.
Yeah, it's all right.
But there's a slide in the macro themes deck that intrigues me, and they talk about the surface caving in.
Yeah.
Now that you're an insider, and granted, I see everyone's pretty open on the call, on the macro show, whatever. But what's it like behind closed doors with things? Even though we're seeing certain sectors struggle, but clearly nothing's caved in yet, or the surface is still pristine. Just your thoughts and what you see on the inside that might help us kind of understand what we're looking for as far as the future is concerned.
Thanks, Josh. What you basically see on the outward is exactly how we are on the inside. So there's really nothing from that perspective. As you mentioned, very open on the call and macro show. Keith is more subdued, obviously, than kind of on the macro show, and he's kind of putting on a bit of an entertainment, right, for the 30-minute show. But realistically, nothing. Who we are on the outside is who we are on the inside. So from that front, really nothing really to add there. It's a phenomenal place to work. It's a great group of people that they all, everybody's got each other's back, and I can't say enough about the wonderful work environment and the group of people that both Keith and Michael Bloom and the whole kind of executive team has put together. So it's a phenomenal place. And then in terms of caving in, I think I think it depends on, we've had GDP has increased again, GDP, the growth side of the equation has gone higher for the last 2 quarters. And a big piece of that component that influenced that was government spending. Now in January, again in Q1, we were cognizant and saw the numbers coming in from sort of a better spending from the consumer, right? So we kind of had that quad one in January, as Keith was kind of calling it out by as we were getting the numbers data rolling in. But I think the surprise, I guess maybe, I don't even know if surprise is the right word, but certainly the government spending piece of the equation has helped buoy the growth number, and therefore sort of the just like what we've seen GDP so far year to date. But if you kind of look at what earnings, especially this, like what's been transpiring the last 2 weeks or so, from an earnings standpoint, you're absolutely seeing some of the things start to cave, and I don't even think we've really gotten a true taste or sort of feel for what could really come down the pipe. So, if you look at just S&P 500 earnings, and it sounds like you're a a big time power user. So I'm just going to say this out loud for everybody else, but 449 of 498 companies have reported earnings for the S&P 500, sales growth of 34 basis points, positive 34 basis points, and earnings growth of negative 828 basis points. So that is, when you got EPS slowing by, call it just over 8%, that is the cave, the basically the surface starting to cave in. Let alone, where you're seeing that those earnings really dissipate, and certainly from a material standpoint, they're losing pricing power. And Mike Green has talked about this last 2 weeks. Sorry, not Mike Green, excuse me. Mike Taylor has talked about this last 2 weeks here on Notebook Review in terms of pricing power. Companies that don't have pricing power are prime opportunities to short, and the ones that are just in the process of basically starting to have to report reality. And you've seen that in the materials sector, where 28 out of 29 companies, they reported sales down 13% and earnings growth down 29%. Same thing with energy, right? They basically they had much better earnings. I mean, even though oil is up in the last month, it has been suppressed the last many months, and certainly the last couple of quarters. So their earnings and sales are down. Sales are down 28%, and earnings growth is down 51% within energy. That's 26 out of 26. So again, I think as you look down across the surface and you see some of this data come in, the QQQ, it does look a little bit different. 77 out of 99 of those, like in terms of the tech kind of 100, call it, they're getting sales growth of plus 4.78% and earnings growth of plus 6.77%. So in that capacity, and I think that's one reason why you've seen the NASDAQ maintain this bullish trend, right? And tech just recently kind of move to a neutral trend on the signal side of the equation. So I think it really just depends. I mean, again, that's just earnings themselves, let alone kind of some of the data and consumer data that's rolling in. I think the big thing with being in-house is that there's a lot of data and analysis that we do that we don't necessarily, all put out there, publish. Ryan Ritchie is an absolute machine. Same with Drago and Tex and Christian Drake. There's those guys are fucking unbelievable from a macro side of the equation. The amount of data that they process and review and send internally. So it's I think that's probably was the biggest eye-opening piece, J.O.S., of going in-house, was just how much, Keith kind of touched on this on the macro shows, that when we present something out to the world, there's a lot of other pieces of the puzzle that are being evaluated and analyzed and consumed to come to that conclusion. So I don't want to be just like, it's not just like a trust me kind of thing or trust us type thing, but just from one guy who's gone from the outside to the inside, I can tell you very firsthand that is absolutely no bullshit, and that is the team. I've never seen a group of guys work harder than this group at Hedgeye.
Thanks, bro.
Yeah, man.
Appreciate the answer.
Yeah, buddy. Yeah. And I think the interesting thing too, J.O.S., is that with this oscillating quad 3, quad 4 environment, you could you might not fully see the cave, right? Like not see, but sorry. Like there are going to be potentially portions of the market, right, that do well, like energy, for instance, is kind of a good example here, where it's was a lead. It was up like 1.26% today, right? And if you look back on from getting kind of like the notebook standpoint, the last month. It's up. Where did I write that down? It's up. It's up like over 9.5% last month, and over 11% in the last 3 months. The only thing that's kind of better would be on a 3-month basis. Nothing's better on a 1-month basis, right? So you've got a lot of things that are kind of XLB, XLF are up, sort of call it 4.5 to 3.5% on a 1-month basis, but on a 3-month, the only things that are better would be consumer discretionary and tech barely, and then XLC. So But that's like, like XLY is going to be a big, obviously a big piece of that is Amazon. So I think you could see areas here over the next few quarters where rather than what we saw in 2022 with like everything going down kind of all together, you could see areas that are buoyed by kind of either inflation and pricing power, right? Or kind of commodities doing better in one capacity versus the growth piece, influencing and impacting another sector much more drastically, right? So think kind of like tech versus energy type stuff. And the component here, and I got it, Mitchell Krause, other side asset management, isn't on tonight, but he and I were speaking earlier today, and he was kind of reminding me about sort of a bit of the rotation and some things that happen. It's not really the rotation, but more kind of like the rebalancing and some things that happened with certainly this rates move, right? So you got this big move in the 30-year and the 10-year. It's impacting TLT, obviously, and other components, but TLTs are pretty widely held. Obviously, fixed income component inside of portfolios, and rebalancing. This could be a component, right, as we go into, it's just the beginning of the month here, but you've got, passive flows that will come in kind of around both the second Friday. So like this Friday, the 11th, and then some folks get paid on like the 15th and the, kind of the 15th and the 31st. So kind of the next sort of week or so, you could see some passive flows come in here and just cause a kind of natural rebalance where, they might just naturally be kind of have to flow towards sort of some of the fixed income components because they have been, down from the last sort of rebalance. So you could have just some of these passive flows influence a bit of the kind of TLT trade versus the QQQ trade, just to use that as an example, right? So that's something to be considering as well and to be cognizant of. Is just that was a big piece, I think, that influenced kind of 2022 is you have to have rates, yields moving higher because of the rate in which the Federal Reserve was increasing their overnight rate, and therefore you just had this constant sort of like rebalance action in the flows, having to just kind of chase or buy lower pricing continuously and having to sell down equities in order to buy fixed income. So that you could see that here in the month of August, depending on what rates do and the yields do, which is why I keep mentioning it. The last 3 weeks, my top three things have been volatility, rates, and the dollar, for lack of a better word. I think this week I went with more of oil commodities, but anyway, or maybe that was last week. But yeah, does that make sense, George?
Yeah, it does. I would say that I'm kind of taking a seesaw approach. So as we oscillate from a sort of quad 3 to quad 4, I'm just when the quad 3 environment's kind of doing well, kind of bring that down and bring up the quad 4 and vice versa. And just my goal is to kind of seesaw the account balances northward and have as little volatility and pullback as possible.
Yeah, that's a pro answer, George, right there. I think that's, and I mentioned this last week, right? You try to have things that do well in both the quad 3 and quad 4 environment, and again, that's just US, right? That's just the US side of the equations, which is one huge reason that Keith has a lot of EEM ex China in the portfolios, because they got quad 1s and quad 2s on the board. So why make it difficult and hard on yourself when you can go anywhere and have exposure to things like Japan and India and that kind of stuff, right? So it's like, yeah, there's this game's hard enough, but finding things that are in bullish trends with the quads that the nowcast that backtest them, the nowcast that the quads that back up the signal is what I'm trying to get at. That's kind of the A/B test that typically equals a really good outcome. All right, well, see if a couple of new people out there. If anybody's got any questions, by all means, pop on up. Happy to answer them. Otherwise, we may wrap up here, kind of pushing an hour and a half. And we can, we'll be back at it next week. So probably another evening session. It's just kind of tricky here in the summertime with the kids' camps and all that kind of stuff. So it'll be the 16th of August. We'll be back at it for the weekly notebook review, most likely in 8 or 8:30 start time, and then taking a little holiday the following week. So there'll be no notebook review on the 23rd, as I'll be in Canada at our cottage on the lake, enjoying some time off with the family, visiting my parents. Should be a lot of fun. With that, no one's really coming up to chit chat, so we will wrap it up. Thank everybody for your participation, for your questions, for your commentary. George, Roland, Muni Guy, greatly appreciate it. And keep keys on a little bit of holiday. So we got David Salem, the Macro Show tomorrow, and then Josh Steiner will be on Friday. And you won't want to miss either one of those guys. They have more knowledge than I could ever imagine putting into this tiny little brain of mine. But appreciate it. They're amazing teammates to have. And with that, I will say goodnight, and we'll see you guys next week.
Don't forget to check out Hedgeye.com to get more actionable investing insights from our team of more than 40 research analysts. And check us out on Twitter at our handle, @Hedgeye. This presentation is informational only. None of the information contained herein constitutes an offer to sell or a solicitation of an offer to buy any security or investment vehicle, nor does it constitute investment recommendation or legal, tax, accounting, or investment advice by Hedgeye or any of its employees, officers, agents, or guests. This information is presented without regard for individual investment preferences or risk parameters and is general, non-tailored, non-specific information. This content is based on information from sources believed to be reliable. Hedgeye is not responsible for errors, inaccuracies, or omissions of information. The opinions and conclusions contained in this report are those of the individual expressing those opinions and conclusions and are intended solely for the use of Hedgeye subscribers and the authorized recipients of the content. All investments entail a certain degree of risk, and financial instrument prices can fluctuate based on several factors, including those not considered in the preparation of the content. Consult your financial professional before investing. The information contained herein is protected by United States and foreign copyright laws and is intended solely for the use of its authorized recipient. Access must be provided directly by Hedgeye. Redistribution or republication is strictly prohibited. For more detail, please refer to the terms of service at hedgeye.com/terms of service.